welcome to Money Matters. My name is Jim Butler with Wealth Enhancement, and my co-host tonight is Jeff Watkinson with Watkinson Capital Advisors. Welcome, Jeff.
Jim, good to see you.
Good to see you. Before we bring on our guest, which is certainly going to have an intriguing story, it's the first time I've heard it, so and I'm sure that'll be true with many of our listeners. Why don't we chat a little bit about an area that you spend a fair amount of time in, and that's the municipal bond market. So to set the table, how would you describe a municipal bond investor? What kind of profile do you see on the retail side?
Well, first and foremost, municipal bonds are the second safest asset class behind U.S. Treasuries. Most investors are looking for tax-exempt income and return of principal. They're essentially looking to stay wealthy, stay rich, and they're looking for the tax-exempt income. So for people in the higher tax bracket or people in very high tax states, they will not paying interest on the bond interest received from the municipal bonds.
They won't pay taxes on the interest, you mean?
That's exactly right. If you're a New Jersey resident, which has a very steep progressive state income tax, and you buy a New Jersey Turnpike bond, that semi-annual interest that you receive will be exempt from federal, state, and local taxes.
Okay.
So essentially, if you're buying you're a New Jersey resident, you're buying a New Jersey Turnpike bond, and you're receiving a 4% yield, that is exempt. You know, the tax equivalent yield, which is what you would have to earn in a taxable fixed income instrument, a corporate bond. You can essentially multiply that number by 2. Mm-hmm. That's the back of the napkin factor. You'd have to earn 8% in a taxable fixed income instrument, corporate bond, to beat that 4% triple tax exempt yield.
When would you recommend somebody, say a resident of New Jersey, buy a bond in another state?
Great question. Some investors prefer more diversification. A New Jersey resident who's a clients of ours will typically go around 70% New Jersey municipals for that New Jersey resident. But with the municipal bond market, there's 50 different states, essentially 50 different markets, plus territories. And at times, there's yield opportunities in other states where even after paying the New Jersey state income tax and local taxes, your net yield will be higher than a comparable New Jersey bond.
And I take it the same would hold true Pennsylvania, New Jersey, Maryland, Virginia, virtually any state that you mentioned, given the choice of available inventory that's out there. Is that fair?
That's absolutely correct. These inefficiencies bubble up, and if you're a Virginia resident and there's good credits in Ohio and the yield, it's underloved, it's underappreciated, and the yield is higher, even net after paying taxes, we will definitely look to add an Ohio bond for a Virginia resident.
What pitfalls would there be in investing in municipal bonds? Any?
Well, it's a very safe asset class. We stick mostly in the investment grade realm. I would stick in the investment grade realm. Secondly, mutual funds, mutual funds is mostly used by individual investors, retail. And what the problem there is, your capital is at risk due to the buying and selling of the other people in the fund. And we saw it in 2011 with Meredith Whitney, and there was a mass exodus from the municipal bond market. We saw it in March of 2020 with COVID, when we looked on the television and there was nobody riding the subways in New York City. Mom and pop, retail investors watched the news. We call it headline risk. You see the headline and they sell. And
Right.
we do SMAs. You're buying individual bonds, and it's like watching your favorite movie. You know how the story ends. You know when you're going to get your money back,
Right.
when and how much interest you'll be paid.
What's happened to the yield curve over the past 12 months?
Great question. The yield curve really dictates where we're allocating capital for our clients. Typically, our clients have about $1 million, and they're looking to stay rich. And the money has a runway of longer than 5 years, 10 years. And I'm going to ask our producer to bring up the yield curve right now. And this is compliments of Bank of America Global Research. And as you can see, the dark purple line, the yield curve's gotten a lot steeper. So to put this bluntly, like from big to small, let's say you had $1 million of capital, you wanted to stay rich, earn the bond interest. If you were to buy, would you rather earn $45,000 of annual bond interest or $21,000 of annual bond interest? Well, if you stay in the short end of the curve with a maturity of 1 to 5 years, we're looking at yields right now at 2%, even below 2%, and you would earn $21,000 a year in interest. That is because a huge demand from mutual funds, from individual investors. Huge demand, huge capital is being put into bonds with 15 years or less maturity. And we're looking at bonds that are 20 years or longer maturity, priced to a 9 or 10 year call to maximize your annual bond interest, your annual income from the portfolio. And the other thing to note is we run into a lot of separately managed accounts from other providers. And unfortunately, a lot of those bonds are within 12, 13 years maturity. And there's nothing wrong with the bonds. They're great credits. They're strong credits, but they're priced sky high because of demand from individual investors.
So it sounds like, in summary, that for those investors who are familiar with municipal bonds, they probably have a head start. They have the familiarity with a lot of the terms that you used. Or if they're not, then they should probably talk to somebody like you to understand, what the field is like and how they can put their money to work.
I would agree with that exactly, and understanding where the opportunity is.
Right.
A year ago, 2 years ago, the yield curve was higher in the short term. We could get a 4% yield out to 7 years, and then the belly of the curve, 10 to 20 years, it was a 3% yield. So it was high, low, high. And we positioned accordingly. The yield curve will tell you where to go.
Right.
Thank you.
Great. Thanks, Jeff. Why don't we switch to our question? A caller has written in. Gail Young in Philadelphia is asking, how do you see AI affecting the municipal bond market?
Great question, Gail. An official statement for a newly issued municipal bond can run 300 pages. AI can quickly do an overlay. You can ask it questions, and you can get answers instantly because AI can read that 300-page document instead of looking at the table of contents, going to page 47, reading the language. Secondly, pricing. Pricing's a huge deal. Sometimes these bonds don't trade for a month, 2 months. What's the bond worth? What should we pay for this bond? What was the price 2 months ago? Was that a good price? What should we pay for that bond today? AI is great at disseminating all this information and helping with pricing in Muni land.
Great. Thank you. Thank you, Gail. And thank you, Jeff. If any of you have a question you'd like our panel to discuss, here's how you write that in.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
So, Jeff, why don't we jump right into our guest for the rest of our time together and open up another opportunity to learn. So we have Josip Rupena, who is CEO of Milo Crypto Mortgage. He is going to join us. Welcome, Josip.
Great to be on the show. Thanks for having me on.
You bet. So for a starting point, I'm going to ask you to briefly describe your firm and your area of expertise, because when I use the term crypto mortgage, all kinds of things come into anybody's mind. So how would you describe what you do?
Yeah, so Milo is a leading crypto lender. So we started the company in 2019 and launched the first crypto-backed mortgage product in 2022. So the way I like to describe it is that we help people not sell their Bitcoin. One of the things that we realized very early on is that there are many individuals, including myself, that have been holding Bitcoin for a long period of time and having to make a very difficult decision. Do you sell your Bitcoin to accomplish some of life milestones like buying a home, or do you weather it out and then forego a lot of those milestones? And what we realize also is that there's a lot of individuals in this country that have invested in Bitcoin, and that's become a sizable portion of their net worth. So through our product and offering, we think we're really helping them, accomplish some of their life goals, and at the same time keep their Bitcoin.
Do you use any other crypto, or is Bitcoin like 90% plus of what you use?
Yeah, we get a lot of requests for other digital assets. I would say that most of the loans we've done, probably about 99% of all the transactions we've done have been in Bitcoin. Some of the other ecosystems have more natural lending markets, nothing like our offering with a crypto mortgage product, but we do get requests. But right now we're focused on Bitcoin primarily because that's one of the assets that we believe will survive the test of time and will continue to appreciate.
Joseph, I got a question for you, and I was kind of in this boat. I was in this boat 6 or 7 months ago, owning Bitcoin, coming up on a move, buying and selling and buying a new place to live. How should I have thought, or how should investors think about using crypto as a collateral? Can you give us like an example, like a base case?
Yeah, that's a great question. Yeah. So if you think about, someone wanting to buy $1 million home, in a traditional mortgage, you would have to have some amount for a down payment, right? 20, 25% as a down payment. Well, what tends to happen is for a lot of our clients that have been holding on to Bitcoin, it's become a significant portion of their net worth. So they may not have a lot of dollars, primarily because they want to be invested in Bitcoin for the long run. Therefore, the decision to have to sell some of their Bitcoin for a down payment would trigger some unintended consequences like capital gains and paying taxes on that. For many of our clients, the fact that the Bitcoin and the expectation from them and many others is that it'll continue to appreciate. So that becomes pretty costly. So in an example, you want to buy $1 million home, someone can come to us and we can finance 100% of the transaction. And the reason why that's significant, because they don't have to now sell for that down payment. So Milo will finance 100% of the transaction. They're going to post $1 million of Bitcoin with us through our qualified custodians. In this case, it's both Coinbase and BitGo, and that collateral is going to sit there. So what we have done is that we've created the first dual collateralized mortgage where we're going to have a lien on the property. And because we're going to be lending at a higher loan to value, we're going to have the Bitcoin as well alongside the real estate. Now, the benefit to the client is that they're not going to pay the taxes, but they're going to continue to have the upside of the Bitcoin. The Bitcoin still belongs to them. It doesn't belong to us. It's additional collateral so that we can lend at a higher loan to value.
I like
So
it.
how-
Well, Jim, can I ask a follow-up question? Obviously, as a Bitcoin investor, I've seen the 50% drawdown since the October, November highs. How does that loan to value work specifically? Let's just stay with this example. $1 million Bitcoin now is worth 500,000. How's that work?
So Milo's done, over $100 million in these transactions so far, and we have never had to ask a customer to post more collateral. The mechanism, and what a misconception about the product is that if the value of Bitcoin goes down, they're going to lose their home. That's not exactly the way this plays out. Like any mortgage, if the individuals are making payments, then there's going to be no issues. If they can't make payments, what's different about our mortgage versus other mortgages is that we can sell a little bit of the Bitcoin to keep them remaining current. Now, in the scenario you're describing, if Bitcoin goes down 50%, nothing would happen because we have dual collateral between real estate as well as Bitcoin. We would only ask for more collateral if Bitcoin fell 65%. And why 65%? Because we looked at historical drawdowns over the last 15 years, and you've had 3 or 4 times where Bitcoin has sold off 60 to 75%. So in our product construct, we designed it in a way where you could support that. And what that has done for us is we started lending when Bitcoin was 40,000. We did transactions when Bitcoin was 15,000, and we've done transactions with Bitcoin being 120,000. And fortunately, we've never had to ask for more collateral. That said, every one of our clients understands that that might be a possible situation. And in that case, customers can post more Bitcoin, they can reduce their loan balance, we can sell a little bit of the Bitcoin to bring down their loan balance. So we have a lot of mechanisms to be able to work through that.
Thank you.
So Joseph, so I can, so that we can kind of put the pieces of the puzzle together. So you finance 100%, and the homeowner pays you because you're the lender, correct? And so they're paying you as if they would pay a traditional bank on a, say, periodic basis, monthly, for example.
Correct, monthly payments. Yes.
So then how do you price that in the market? Do you price it similar to how a traditional a mortgage lender would price it, or how do you come up with that formula?
That's a great question. So if you think about most mortgages in the U.S., they're either conforming or non-conforming. Conforming means that they go to Fannie, Freddie, right? Some of the agencies, it might be an FHA loan. And then non-conforming are mortgages don't necessarily fit, and they have an alternative underwrite to them. So we sit in that second category. Naturally, we have access to capital. Fortunately, we've got great investors that have given us capital to go out and build the business, build technology, implement AI, and become very, very efficient at originating our mortgages. But we also have a cost of capital, right, from our institutional lines of credit. And then that allows us to think about, what are those spreads so that we can maintain a healthy margin between what is our cost of capital and what we're able to put out that capital. Just to give you some idea of rates, traditional mortgage rates today tend to be sort of in that 6% range. We're going to be somewhere in the 7s to 8s, so slightly higher. But we move in line with the market. So when we started doing these loans in 2022, our first loans were in the high 4%. Some of our higher rates were somewhere in the 9s, and sort of, it just will fluctuate according to the markets. That for us is something that's really exciting, is to think about what can we do as more traditional capital is coming into the ecosystem, from traditional players and banks and warehouse lenders, so that at some point we might be able to securitize our loans and then be able to drive those rates even closer to something that is more in line with a conventional rate. Considering the fact that this isn't necessarily a riskier loan. In fact, there are many characteristics of our loan that make them much safer. It just means that we're still early in the cycle where a lot of institutional investors have not seen this type of mortgage product.
Do you have much competition?
So we started, we were the first company to do this, and we were the first company to get out there and originate in April of 2022. We've seen different companies come into the space, and then we've seen them leave over the years, primarily as it became, on the other side of sort of the frothiness of the market in 2022. Now we're starting to see some more players come into the space. I expect some banks to start to dabble as well. So yes, we do expect more competition, and we encourage it, because I think that that's going to be the best way of creating awareness around this product, because we believe there's millions of clients all around the US that have Bitcoin. And as this asset class continues to mature and grow, that'll become a bigger portion of clients' net worth.
Milo, so you did your first, crypto collateralized mortgage in April 22, and I've read that you've already surpassed $100 million in crypto mortgages. What does that number, that $100 million, signify? What does that milestone signify for mainstream adoption?
I think it reflects that it is a category that's growing. It's something that in the early days we were really trying to convince a lot of market participants of how it would perform, and now we've gone through 2 sell-offs and can show and validate why it works and why we're very confident that this is a good offering for clients. We've also seen, not just from the side of the origination number, but what it has meant for the clients that did work with us, and what has that meant for them in terms of their net worth, where it's only gone up from when we started originating. So I think it's a nice round number that shows that this is not just a couple transactions that may or may not be arm's length. This is something where there are clients all over the country that are discovering Milo, that are building conviction to go out and buy a home, and that we're helping lots of families. And this is a very different scenario in terms of sort of how you think about affordability, right? We always think about affordability in homes and mortgages as people that can't buy. We rarely think about the customers that actually would like to buy, but don't buy because it's just not the right financial decision for them. Every single one of our clients could actually pay for these homes by liquidating their assets, but they're choosing to defer it. So I think that it's a nice milestone, and we're happy to continue to celebrate, hopefully even greater numbers, because that means that the work and the education and everything that we're doing is really getting out there and helping a lot of people.
So Josip, go back to the math of your example. If somebody they're buying a $1 million property and they're going to put 20% down, let's say they only have $100,000 or willing to part with $100,000 of crypto or Bitcoin. Can they use the other remaining balance, say another $100,000 in cash?
Yeah, that's a great question, and that was one of the scenarios and how we've evolved from the original product of being the 100% financing. Is that we do find that individuals do want to put some money down, and if they do want to put money down, then they're able to post less Bitcoin with us. So generally, it tends to be from that 65-70% mark. At that point in time, if they have Bitcoin, that's going to help us underwrite them for the mortgage. They may not need to post any collateral with us. And as we start to tier up in loan to value, which increases our risk, that's when we start to require them to post some Bitcoin with us.
Joseph, I got a question for all the neophyte Bitcoin investors out there. Let's just say an investor's just starting off, they're interested in Bitcoin. What avenue, what vehicle would you recommend getting exposure to Bitcoin, and how would you start if you were a beginning investor in Bitcoin? How would you start building a position?
Yeah, I think today, we're seeing a lot of individuals that didn't buy Bitcoin in the last, I would say 24 months, have been getting exposure to the asset class via the ETFs. So the ETFs are something that is very normal for individuals to have brokerage accounts, retirement accounts, IRAs, 401ks, and other products. So we're starting to see more people come into the ecosystem through these ETFs. And what we found that's really interesting is that the individuals that might have worked and bought Bitcoin 10 years ago, those individuals might have bought $10,000 of Bitcoin. Today, I would argue that some of the people that are buying today have an even greater conviction in Bitcoin because they're buying it through their brokerage accounts, and they're buying 50,000, 100,000, even more sometimes of a Bitcoin position. So I think that that's a great way to get exposure to it, but then to not stop there and continue through that journey to really understand, what does it mean to buy Bitcoin, to be able to self-custody their Bitcoin, to work with Coinbase and others that are out there, and get educated around, what is this technology of blockchain, and then how are other things changing out there? Because there's so much to learn, but it's definitely the easiest to start off with Bitcoin and following it, watching it, and then getting more familiar with the lingo.
Joseph, my guess would be that traditional banks would be very slow to walk down this path that you're forging, largely for a variety of reasons. They're hesitant, they don't understand it, they feel it's too risky. So my guess would be you're in the early innings of really opening up a new market for lending, for asset purchasing. And I mean, I would think that could lead to any number of things. How about regulations? What regulations, if any, do you have to adhere to as a firm?
Yeah, a lot of regulation, right? So, I think that there's this misconception that by throwing the word crypto, it means that you're no longer have to play by rules. And, that couldn't be further from the truth, right? First and foremost, right, we're a lender, which means, we lend to individuals that live in different states. So we have to have lending licenses. We've got about a dozen of those different licenses, and we lend, and we have to file quarterly audits, and we have to file financials, and we have, a tremendous amount of, I would say, regulatory requirements to our business. So it doesn't really negate that from the fact that, we're dealing with Bitcoin.
So I have another question. What other assets, or how else are investors leveraging their Bitcoin in the marketplace right now?
Yeah, so we have two products. We have the mortgage offering, and then we also have the loan offering. And the loan offering is for someone that has $100,000 of Bitcoin, and they may want to borrow some dollars against that because they don't want to sell their position. And very similar to the mortgage, the only difference here is that they can use the proceeds of that loan for a number of different things that they want. And in this example, they'll post $100,000 of Bitcoin with us and one of our qualified custodians, and they can borrow $50,000, which they can then use however they like. What's nice about that product is that it can defer the interest, so it becomes accrued, and then they can pay it off after a year, or they can continue to roll the loan. So we're seeing a lot of clients, start to think about how they use their Bitcoin. They don't want to sell their Bitcoin. It has performed phenomenally well for them, but really sort of synonymous to how you would think about a margin loan or some type of line against your brokerage account.
Interesting. Yeah. Well, again, you've embarked on something, I think that, it carries some risk, but any business carries a certain amount of risk. And there's going to be volatility, but, all business has volatility. And even though we don't like to date ourselves with the taping of the show, but, Josip, we're in the midst of a lot of international uncertainty, and at some level that spills into our economy. But in any event, thank you for your insights. And hopefully anyone interested is taking some good notes and can find you either on LinkedIn or doing a more traditional internet search. Very fascinating. So, and thank you to our listeners for tuning in. Hopefully you've learned something, whether or not you're a Bitcoin and investor or not. Next week's guest is, I'm going to say, Lily from Water Lily. Her last name I'm not going to touch because I'd probably mess it up. But in any event, she uses AI to navigate long-term care protection, and that's certainly a field that will continue to grow. So in the meantime, thank you for listening. Hope you've learned something, and thank you to our guest. And until next time, thanks again.